Think about the absolute safest place you can keep your money. For most people, it's a traditional bank savings account. But the math dictates a strange paradox. Retreating to this seemingly safe vehicle is a mathematical guarantee that you will become poorer over time. You have been taught your entire life that saving raw cash is the responsible adult thing to do. In the modern economy, however, adhering to that conventional advice and hoarding cash is a direct path to financial ruin. Today, we are going to look at the exact numbers behind what I call the scarcity trap. We will break down the macroeconomic math that forces your savings to shrink, and then we will conduct a personal audit of your cash to locate the leak. Understanding how this trap functions is your mandatory first step. Once you see the math, you can stop playing a game designed to make you lose and start executing a verifiable wealth-building strategy. Let's clearly define the scarcity trap. It is a psychological instinct. When people feel uncertain about the economy, they hoard their cash out of a deeply ingrained fear of losing what little they have. That fear completely blinds them to the mathematical reality working against them in the background. To see that math clearly, you have to look at the money printer. The idea that there is a fixed, finite supply of money in the economy is a myth. The root cause of our continuously expanding money supply is a system called fractional reserve banking. This diagram illustrates exactly how that system operates. When you deposit $100 into your bank, the bank does not put it in a vault. They are legally allowed to lend out roughly $90 of your deposit to someone else. By issuing that debt, they are effectively creating new money out of thin air. Central banks compound this effect. When the economy experiences a dip, their primary response is to inject massive amounts of newly printed currency into the system to stimulate spending. As the overall supply of money rapidly multiplies, the slice of the pie that you hold visually and mathematically shrinks. We call this constant expansion of the money supply inflation, but practically speaking, it is an invisible thief living permanently inside your bank account. Look at this formula to calculate your specific leak. If real inflation is running at 5% and your high-yield bank account is paying you 1%, you have a mathematically guaranteed loss of 4% every single year. The $100 bill sitting in your account looks physically identical today as it did a year ago, but its purchasing power, the actual utility of that money, is melting away while it sits idle. Now that we understand the math of the money printer, we need to apply it to your daily routine. Think about your daily groceries, which have noticeably increased in cost over the last 3 years. Our brains naturally assume that the items themselves have become more expensive. I call this the avocado toast illusion, and it stems from a basic misperception of supply and demand. This split-screen visualization breaks down the illusion. Notice the items on the left. The actual physical supply of avocados, bread, and the labor required to harvest them has not drastically changed or suddenly become rarer. The reality is shown on the right. Because central banks drastically increase the total supply of currency, each individual dollar you hold is worth less. The goods didn't go up in price. The purchasing power of your dollars simply went down. This forces us to look past physical goods and examine opportunity cost. Every dollar you earn is a direct exchange for your human labor. When you work entirely for a depreciating currency, you step onto an economic treadmill that perpetually speeds up. You have to expend more physical energy every single year just to maintain your current position. To step off the treadmill, you have to adopt a specific mindset shift. You can always print more fiat currency. You cannot print more time or life energy. Your time is your ultimate scarce asset. Leaving your cash idle in a savings account is an active, unrecoverable waste of the finite life energy you spent to acquire it. The operational solution to this math problem is straightforward. You must abandon the behavior of a hoarder and adopt the behavior of an investor. We execute this through step 3, the asset exchange. This is the deliberate process of moving your capital out of depreciating vehicles, like raw cash, and reallocating it into appreciating vehicles. Here are the 3 distinct target categories for your wealth reallocation. First, the stock market. Buying equities allows you to capture corporate growth that historically outpaces the rate of inflation. Second, real estate. Purchasing property gives you a hard, physical asset that serves as a direct hedge against currency dilution. Third, and often most important, high-income skills. Investing capital into your own education is the most controllable method of increasing your personal leverage and earning power. The primary reason people fail to make this exchange is psychological. It is terrifying to watch asset prices dip on a chart. It triggers our natural loss aversion, turning the financial markets into what feels like a casino. But you have to weigh the fear of a volatile chart against the reality of your savings account. One carries the risk of a temporary dip. The other carries the mathematical guarantee of an invisible theft. Enduring temporary market volatility is a mandatory, rational trade-off. It is the only way to escape the absolute certainty of permanent inflation loss. The math is objective. Remaining in raw cash guarantees a financial loss. To help you finalize your personal cash audit today, I have built the tool you see here, the Rational Investor's Checklist. Use the link in the description below to download this checklist right now. Use it to locate exactly where your current money is leaking value. Once you run the numbers, leave a comment below. Tell me publicly, which specific asset class are you going to start migrating your idle cash into? True wealth is generated through rational systems, not endless manual labor. Master your mind, master your money. I'll see you in